So let's talk about some strategies of how we tackle these problems. So, we're using our time value of money, discounted cash flow skills to do this. And one thing that's important to note is that corporate bonds almost always pay interest on a semi-annual basis. That means that we need to use our skill set that we've developed about how to handle compounding when it occurs more frequently than annually. Okay, because there's semi-annual compounding, what that means is that the coupon payment is going to be divided into two and it's going to be paid every 6 months. So as we input things into the calculator, we want to remember to keep things consistent, right? And each period is going to be 6 months long. So N should represent 6 months, I over Y should represent 6 months, and the payment should represent 6 months. The present value and the future value, you don't have to make any adjustment. Okay, so typically these questions will either ask you to solve for the price of the bond, like the market price of the bond, or it'll ask you to solve for the yield to maturity. Now, the yield to maturity represents the amount or the rate of return that I would receive if I were to buy the bond today and hold it until it matures. That's different from the current yield, which is representative of the coupon payment that I get paid this year divided by the price that I pay. The yield to maturity is a little bit more frequently used. So typically what will happen is, I'll give you some indication that the bond is yielding a certain amount, and I'll ask you to compute the price. Or I will give you a price of the bond and ask you to compute the yield. So it's important to understand that these two are related. And they're related just mechanically or mathematically through the formula. And importantly, the two have an inverse relationship. So if one goes up, the other goes down. So if the price of the bond goes up, then the yield automatically will go down. And that's just, it's a mechanical relationship, and it should kind of make some intuitive sense as well, right? Because the higher the price you pay, the lower your ultimate return is going to be. So as an investor, what you're always looking to do is pay as low of a price as you possibly can, because that is going to increase your potential return. All right, so that's a general overview of what these corporate bond problems look like. But just like when we did the basic time value of money stuff, there were 5 inputs, and that's the same case here. There are 5 inputs, and basically in the problem I would give you 4, and you would be required to solve for the 5th. And that's essentially what we're doing here, except now we're applying it to something that is kind of more real life, which is the corporate bond. So I could ask you to solve for like the maturity of the bond or the coupon payment or something like that, and that's definitely plausible. But what's more common is to give you a price and ask you to solve for the yield, or give you the yield and ask you to solve for the price. All right, so here's an example. Let's suppose we need to find the market price of this bond. So we have Sugar Factory, which offers a bond with a coupon of 8.25%, with semi-annual payments and a yield to maturity of 12.75%. The bonds mature in 15 years. What is the market price of a $1,000 face value bond? Okay, one thing to note, to keep in mind, is that the face value is almost always $1,000. In some examples, you'll see, the face value is a different amount, maybe $2,000 or $5,000, but that's going to be relatively rare. Usually the face value is going to be $1,000. And that's typically what as long as, the company issues the bond at the market rate, which is pretty common, using a coupon rate at the market rate, then the company can sell the bonds for face value. And so if they need to raise $200,000, then they would sell 200 of these bonds to investors. Does that make sense? All right. So let's solve this example. So, just like when we solve the basic time value of money problems, we need to identify each of the 5 inputs for the time value of money and recognize what we have and what it is that we need to compute. And we also need to be able to relate the terminology for the bond to what we already know about the time value of money. And I'm going to help you do that as we work out these problems. All right, so first is going to be N. Now, N represents the maturity of the bond. But remember, because of semi-annual compounding, each period represents 6 months. So this bond matures in 15 years. So you have to think to yourself, how many 6-month increments are there in 15 years? And the answer is 30. All right, I over y. Now, I over y is associated with the yield to maturity, and it represents 6 months. So we know the yield to maturity because that's what we're given. So we put 12.75 divided by 2, and that is going to be 6.375. And that's what we're going to input into the calculator for I over y. The present value represents the price today, and that is something that we don't know, right? That's what we're asked to solve. So we're going to leave that as the question mark. The payment refers to the coupon payment. Now, we're given the coupon rate, which is 8.25%. So how do we find the coupon payment given the coupon rate? Well, the rate refers to the amount that they pay, the rate on the face value. So being given the face value of $1,000, the coupon payment is going to be 8.25% of that $1,000. So that's going to be $82.50 divided by 2, and that gives us $41.25. And then the future value is the $1,000 face value, which gets paid at the time that the bond matures. And that's another important thing to recognize about how bonds are different from, say, like a mortgage loan or an auto loan. And that is, in a mortgage loan, each payment consists of both principal and interest. In other words, the principal is amortized throughout the life of the loan. But that is not the case for corporate bonds. Corporate bonds, the payments are 100% interest, and the principal isn't paid back until the very end, which is, in this case, $1,000 per bond. So, you can imagine what the timeline looks like. Over the course of the timeline, we have payments, but those payments only represent interest. They don't represent the paying back of principal. And so because of that, the principal is repaid at the very end. Now, in practice, what is very, very common is, because, the principal amount will come due at the time that the bond's going to mature. And what tends to happen is that they'll refinance, right, and kind of keep the loan going. So that's kind of what it looks like in practice. But we can go ahead and solve this and, figure out the price. Okay, one other thing to know before I input this into the calculator. Before going to the calculator, what you want to make sure you do is you want to make sure that you have your signs right for this group of 3 right here. The sign, remember, refers to the direction of the cash flow. When I pay for a bond, I'm taking cash out of my pocket and giving it to, the seller of the bond, and in return, I'm getting the bond. And so think of it as a cash outflow. So present value, PV, should be negative because it represents a cash outflow, what I pay for the bond today. But in return, what I receive, so cash flow coming back into my pocket, are the coupon payments of the bond and the par value that occurs at the very end. So I want to make sure that the payment is positive and the future value is positive. That's going to make the present value negative. And yes, that makes sense to me. Okay. If I have these signs wrong, then I'll get a wrong answer, or I could even get an error sign pop up in the calculator. So I don't want that to happen. All right, so now I'm going to make sure I clear out anything that may be in the calculator left over from prior problems. And now I'm going to solve it. So 30 is my N. 6.375 is my I over Y. 41.25 is my payment amount. And 1,000 is my future value. So I compute the present value, and I get 702.33. And you can see, yes, it's a negative sign, which indicates that the cash flow is going away from me because that is what I'm paying for the bond today. And that's it for that problem. All right. So next, we have another bond price problem. And so in this case, we have Auburn T-shirt Company offers a bond with a coupon of 6.5% with semi-annual payments and a yield to maturity of 5.25%. The bonds mature in 5 years. What is the market price of the bond given a $1,000 face value? All right. Now, really quick, when I go back here, I notice that the yield to maturity is greater than the coupon rate. Importantly, what this tells me is that I need to price the bond so that a coupon rate of 8.25% is attractive to investors in a market that is paying 12.75%. Does that make sense? If I have bonds that are paying only 8.25% and the rest of the market is paying 12.75%, nobody's going to want to buy my bonds. So what do I have to do? I have to lower the price. And so anytime that you see a situation where the yield to maturity, what the current yield is, and it's greater than the coupon rate, then what's going to happen is I'm going to have to price the bond lower than face value because I'm going to have to discount it in order to entice investors to want to buy a bond that is paying 8.25% in a market that is paying 12.75%. Okay, I hope that makes sense. In this situation, we have the opposite. So we have a bond that is paying 6.5% in a market that is only paying 5.25%. So in this case, now we have something that investors really like. And it's going to be really easy for me to sell this. But I'm not going to sell it for face value because I would be doing myself a disservice. So I'm going to increase the price of the bond such that the yield equals what the market is yielding today, 5.25%. If I were to sell it at face value of $1,000, then the yield to maturity would be exactly equal to 6.5%. That's another important concept. If the price of the bond is the same as face value, then the bond is simply going to yield its coupon rate. Okay? But if I increase the price of the bond, then the yield is going to go down, and I'm going to decrease the price of the bond just enough so that the yield to maturity, so that the rate goes down and touches 5.25%. Does that make sense? So in a market that is where yields are 5.25% and I have a 6.5% bond, that's a good thing, right? I can easily sell that, but I'm going to increase the price such that the yield equals 5.25%. All right, I hope that makes sense. Now let's go ahead and solve this problem, lay out what we know. So the N here is going to be referred to the maturity of the bond, which I can see is 5 years. But I need to multiply that by 2 because I'm thinking in terms of 6-month increments because there are semi-annual payments. And so my N is going to be 10. My I over Y refers to my yield to maturity, which is 5.25%. But that's an annual number, so I need to divide by 2, and that's going to give me 2.625%. The present value refers to the price of the bond, which is what I'm solving for, so I'm going to leave that as the question mark. Payment refers to the coupon payment, which I can see the coupon rate is 6.5%, and the face value is 1,000. And remember, the coupon rate refers to the rate that the company is paying on their face value. So I take the coupon rate, which is 6.5%, multiply it by 1,000, and I get $65. I multiply that by 2 because the $65 is what is paid annually. I need the 6-month payment, so I divide by 2, and that is 32.5. And then my future value is the face value amount, which is 1,000. Okay, I want to make sure my signs are right. So yes, the payment's going to be positive and the future value is going to be positive. That is going to make the calculator spit out a negative number for the present value. All right, so 10 is my N. 2.625 is my I over Y. 32.5 is my payment, and 1,000 is my future value or face value. Compute the price. I get 1,054 and basically 35 cents. Okay, so notice the price is greater than face value. Again, the price is greater than face value because the yield to maturity is less than the coupon rate. Okay, so that's an important relationship to understand, and you may have to look at that multiple times in order for that to kind of solidify in your brain. And at some point, hopefully it'll click for you and you can recognize, oh yeah, if the yield to maturity is less than the coupon, I'm going to have to price the bond greater than face value in order to, sell it for what it's worth. All right, now let's find the yield to maturity. So we have Dapper Donuts has a bond outstanding with a coupon rate of 5.5% and annual payments. Okay, the bond currently sells for $950.50, matures in 12 years, and has a par value of 1,000. Okay, in this case, it says the payments are not semi-annual, they are annual. So that simplifies it for us. And so let's take a look at it. All right, so our N is going to be the maturity, which I see is 12 years. Our I over Y is going to represent our yield to maturity, and that is what we're solving for. Our present value is what we pay for the bonds today, and that is $950.50. Now remember, if I'm paying for the bond today, then cash is going out of my pocket, going to the seller, and in return I get the bond. So I'm going to have a negative cash flow here of $950.50. The payment is the coupon rate of 5.5% multiplied by 1,000. So that gives me $55. And my future value is my par value, which is 1,000. All right, so now I can solve the problem. 12 is going to be my N, 950 and 50 cents. Negative is going to be my present value. 55 is the payment, and 1,000 is the future value. Compute I over Y, 6.09. All right, so 6.09%. Now, just reminding you of what I had explained just a minute ago, I can see that the price is less than the maturity, than the par value. If the price is less than the par value, that means the yield is going to be greater than the coupon rate. Okay? Remember, price and rate have an inverse relationship. So if I increase the price, I'm going to lower the yield. Or if I lower the price, I'm going to increase the yield. So if I lower the price from 1,000, I'm going to increase the yield from 5.5%. So that's why when we found we found the answer to be 6.09%, which is greater than 5.5%. And makes sense because the price is less than 1,000. Okay. Another example, another one where we're finding the yield. So there's a bond that has a quoted price of 104 and a par value of 2,000. Coupon rate is 7.5%, and the bond matures in 15 years. If the bond makes semi-annual coupon payments, what is the yield to maturity of the bond? Okay, so now we're dealing with semi-annual coupon payments, which means we're thinking in 6-month increments. And we have a par value that is different from 1,000, 2,000. That's not a problem though. And we have a coupon rate of 7.5%. Quoted price. Now, this is important too because this is common in the bond market, just something you have to get used to. The quoted price is kind of like a percentage. It's saying the price is 104.5% of the par value. It doesn't mean that the price is selling for $104. It means it's selling for 104.5% of the face or par value. Okay, so that's something that's tricky, but common in the bond market and just kind of part of the language of the bond market that you have to get used to. All right, so let's go ahead and solve this problem. N is going to be the maturity, which we see is 15 years. But remember, semi-annual compounding, so we're thinking of 6-month increments, and there are 30 6-month increments in 15 years. I over y is what we don't know. That's what we're solving for. Present value is the price. Now, this is important because the price was given to us in terms of a quote, which is a percentage. And so we take 2,000, multiply it by 104.5%, which is multiplying by 1.045. And that gives us $2,090. The payment, I should make that negative because that's the price that I'll pay cash going out of my pocket. The payment is the coupon rate of 7.5% multiplied by the par value amount. So 0.075 times 2,000 is 150. Now that's the annual payment, so I divide that by 2, and what is actually paid is $75 every 6 months. And then lastly, we have the par value amount, which is 2,000, and that gets paid back to us at the end when the bond matures. All right, so now let's go ahead and put this into the calculator. We have 30 for our N, 2,090 negative for our present value, 75 for our payment, and 2,000 for the future value. Now we compute the I over Y, and that gives us 3.51. Now, importantly, we have to multiply this by 2 because that represents 6 months. So we do times 2, and that equals 7.01%. And that is the yield to maturity. All right. Let's look at another one. Okay, in this case, this is a little bit odd, but we're going to find the coupon payment. Now, all this means is that in the calculator, we're solving for the payment amount, which we've done before, but not in the context of a bond. All right, so we have a 16-year semi-annual coupon bond selling for $945. Par value is 1,000, yield to maturity 7.14%. What is the bond's coupon rate or coupon payment, right? All right, so N is the maturity, 16 multiplied by 2 equals 32, right? All right, I over Y is given to us. It has a yield to maturity of 7.14. That's an annual number. We divide it by 2 for every 6 months. That is 3.57. And then we have our present value, which is what the bond is selling for, which is negative 945.32 cents. Then we have the payment amount, which is what we don't know, but when we solve for it, it will be a positive number and it will represent what is paid every 6 months. And then the future value is the par value amount, which is 1,000. All right, so let's put this into the calculator and see what it tells us. 32s are in, 3.57 is our R over Y, 945.32 negative is our present value amount, 1,000 is our future value. Compute the payment. 32.81 or so. Multiply this by 2, we get $65.61. This is the coupon payment amount. Technically, it asks for the rate, so we divide that by the par value of 1,000, and we get 6.56%. And that is the bond's coupon rate, which was determined when? At the time the bond was issued. And remember, the coupon rate never changes. The coupon payment never changes. Only going interest rates change. So the yield to maturity changes, but the coupon rate never changes. All right, so here's another one. Seether Company wants to issue 15-year bonds for some much-needed expansion projects. The company currently has 6% coupon bonds on the market that sell for $850. They make semi-annual payments, and they mature in 15 years. What coupon rate should the company set on its new bonds if it wants to sell them at par? All right, so this question requires you to know a few things. One is that at par, if the price is equal to par, then the coupon rate is going to be equal to the yield to maturity. Now, the yield to maturity we can find on the company's existing bonds. So that's what we're going to do. We're going to find the yield to maturity on the company's existing bonds, and that will tell us if the bond issued, or if the company issued bonds today, what rate would they pay? That's the yield to maturity. All right, so let's set up N equals, semi-annual payment, so we do have to account for that. N is 15, multiply that by 2, 30. I over Y equals the yield to maturity, that's what we don't know. Present value is the price of the bond. You can see they're currently selling for $850, so I'm going to put negative $850. Payment represents the coupon payment on these bonds, which you can see they have 6% coupon. It doesn't give you the par value, but you can assume that it's 1,000. And so if that's the case, then the payment's going to be 60 divided by 2 equals 30 every 6 months. And the future value is going to be the par value, which is 1,000. All right, so let's input this into the calculator. 30 for N, 850 for the present value for the price, 30 for the coupon payment amount, and 1,000 for the future value. Compute the I over Y. We get 3.85%. Multiply that by 2 to get the annual amount, and we get 7.70 approximately. So the question is, what coupon rate should the company set on its new bonds if it wants to sell them at par? Well, the answer is 7.7, because that would make the coupon rate equal the yield to maturity. And if that's the case, then the price of the bond is equal to par. All right. I think this is one of the last ones. All right, let's take a look at a special case, which is the zero coupon bond. And as the name implies, it means that the bond does not make interest coupon payments over the life of the bond. Instead, it discounts the price today and pays par value at the very end. And so the return that the investor receives is through the price increase of the bond, essentially the difference between what they pay today for the bond and when they receive the par value amount at the very end. Okay, so we have this interesting company here, Crazy Clowns Party Industries, plans to issue new zero coupon bonds with a par value of 1,000 to fund a new project. The bonds will have a yield to maturity of 8.4% and will mature in 10 years. If we assume semi-annual compounding, at what price will we sell the bonds today? All right, so let's talk about how we input this into the calculator. Now, N is going to represent the maturity. But with semi-annual compounding, we're thinking every 6 months. So N is going to be 10 multiplied by 2 for 2 6-month increments in every year. And that's going to give us 20. I over Y is our yield to maturity, and that is given to us of 8.4%. That's an annual number, so we divide that by 2, and that is going to be 4.2%. The present value is the price of the bond. That's what we don't know. The payment amount, remember the definition of the zero coupon bond is that it pays no coupon, so that's easy, 0. And the future value is par, which is 1,000. All right, you see that setup? With the zero coupon bond, we don't make payments, so payment is always going to be 0, which means that the return the investor receives is not from the cash flows and the in the middle over the life of the bond. Instead, it's only from the difference between what the investor pays and when it receives par value as the bond matures. So let's input this into the calculator and see what it spits out. 20 is our N, 4.2 is our I over Y, 0 is our payment, 1,000 is our future value. We compute the present value, and of course it's negative, as we expect, because the calculator has to balance, $439.18. So, the question is at what price will the bonds sell? So, one thing that I could potentially ask you is, if the Crazy Clowns Party Industries company wants to raise $100,000, how many bonds do they have to sell if they're zero coupon bonds like this? And in this case, each bond has a par value of 1,000, but the company can only sell it for $439. So if the company wants to raise, say, $100,000, then you would say 100,000 divided by each price of the bond, which is be 439.18, and they would have to sell, basically 228 bonds. So that's just an example to give you an idea of what it might look like in practice. All right, so that's it for the examples that I have, but just to kind of end this, I want to let you guys think about things conceptually for a second. So if for example, if the going interest rate is 5%, what must interest rates be for bonds to sell below par? Now, remember, I've mentioned this a few times now, but the relationship between the price and yield is inverse. So if one goes up, the other automatically goes down. And specifically with respect to let's see what must, okay. So what I should say here is if the if a bond's coupon rate is 5%, what must interest rates be for bonds to sell below par? So with respect to the coupon rate and par value specifically, if the going interest rate is greater than the coupon rate, then that means the bond is selling for less than par value. Okay, so if the coupon rate is 5%, what must interest rates be for bonds to sell below par? Well, they must be greater than the coupon, right? So the going interest rate must be greater than 5%. All right, if all else equal, if interest rates rise, will you be able to raise more, the same, or less debt capital? Well, that's an interesting question because it refers to the price of the bonds. Like if you had set to issue, 1,000 bonds and you were all ready to go and then interest rates moved pretty dramatically, would you be able to raise the same amount? And the answer is no, because if interest rates rise, then the price of the bonds will go down. And so ultimately what you can sell them for, the amount that you can raise will go down. Let's see, your company's bonds are currently selling for more than par value. Are current interest rates higher or lower than the coupon rate? All right, so this is another one that goes back to this relationship between prices and yields, and specifically, par value, coupon, and price and yield to maturity. So if the bonds are selling for more than par, then that means they're selling at a premium, and so the interest rate is going to be lower than the coupon because of the inverse relationship. Your company's credit rating has been downgraded from AAA to BBB since issuing bonds a year ago. If general interest rate levels haven't changed, has the yield on your company's bonds increased, decreased, or stayed the same? All right, so this is an important one too, because, if you remember from the lecture, our discussion about credit quality and credit ratings, not all companies are created equal, right? Some are more safe than others. And because of that, some companies that are particularly risky, investors are going to require a pretty significant rate of return. So if your company's credit rating has been downgraded, that's not going to be good for when you go to the bond market and you start raising debt capital, because investors are going to set a high required interest rate or high yield, and that means that you're going to have to sell the bonds at a pretty significant discount. Okay, so even though the going interest rate level hasn't changed, your company, with respect to, the tiers in the market, as you decrease in credit quality, the interest rate, the required yield gets higher. The yield on your company's bonds is probably increased to reflect that additional risk. An upward sloping yield curve indicates that longer-term bonds are higher, the same, or lower than interest rates, or than short-term interest rates. Remember, the yield curve gives us an idea of the relationship between maturity and yield. Usually, it's upward sloping. And if it's upward sloping, it means that bonds with shorter maturity are yielding lower than bonds with longer maturity. And so if it's upward sloping, that means longer-term bonds are going to be higher than short-term bonds, or long-term, and then short-term rates. Okay. All right. I hope this was helpful. As always, if you are studying and you have any trouble, please send me an email. I'm happy to help.